Most people don't know how to make money using options on stocks. The easiest strategy is covered calls. If you want to produce income, use your stocks to produce income by selling call options on your stocks. This is the easiest strategy to produce consistent monthly or weekly income. And in this video, I'm going to give you the step-by-step process if you're a beginner or even if you already have some experience on how to properly sell covered calls and my tips and tricks for maximizing my income by using this strategy. Real quick on the screen, you will see what I'm going to cover in this short video. I'm going to be covering step by step how to execute covered calls, some real examples and actual numbers of how much money you can make, common mistakes that lose money and things that you should be avoiding if you want to maximize your income, and when to use this strategy, which stocks, and how to properly choose the covered call position. We'll be also talking about opening and closing the position from start to finish so you can understand the strategy on a deeper level and make a lot of money using it. Quick disclaimer, this is educational only. I'm not a financial advisor. I'm a guy on the internet who has had really good results and has been trading options for 10 years, but there's a few risks and I will be talking about those risks using covered calls. I'm going to tell you ahead of time that covered calls are very minimal risk, but of course, there is some trade-offs versus just holding stock. So we'll talk about that on a chart a little bit later in this video. Now, here's kind of like the framework for a covered call. Most people own 100 shares of a stock and they just wait for the stock to go up. A covered call actually produces income because when you sell it, that is a position that brings in income since someone else buys a call option and you're the one that sells it. So owning 100 shares of any stock will allow you to do a covered call position. So for example, if you have Apple at $230 per share, that's $23,000 just sitting around. Now, of course, Apple stock can go up, Apple stock pays a small dividend, but for the most part, you're just waiting for the stock to appreciate and maybe get a dividend of like 0.5%. Instead, what you can do is you can leverage your 100 shares and sell a covered call option that gives you income and produces cash flow. So here's what can happen. You can actually view this as an additional dividend, an additional cash flow. So traditional, ETF like S&P 500 only yields 1.4% in dividends per year. That's not going to be that much money. And if you look at other opportunities, most stocks pay, 2 or 3%, even if they're a good paying dividend stock. So instead, if you want to produce income, a covered call position can make 1-2% a week or a month rather than having to wait an entire year. So it speeds up the process of cash flow and it allows you to produce income and have a consistent income. I've been using that for my portfolio here. My portfolio is over $4 million and I've been withdrawing money consistently. And now I'm not so much in the growth stage, I'm more so in the spending and just taking out the cash flow stage. So the portfolio now has reached maturity and I've done this in a reasonable amount of time, less than a decade, and I've retired. So you can do the same exact thing by adding money to your portfolio using covered calls as a strategy to produce income and then, travel the world or, fund your lifestyle with your family, etc. So let me explain to you kind of like the breakdown here in just like 2 minutes. If you own 100 shares, selling someone the right to buying your stock is the way that you produce cash flow up front because they make a payment to you when they purchase a call option and you're the one that sells it to them. Okay, you can think about this kind of like similar to a house analogy. I'm going to make a quick house analogy. Let's say that you have a house that's worth $500,000 today. Someone pays you $5,000 right now, this very minute, to buy the house from you for $520,000 within the next 30 days. The house goes to $550,000. Well, you have to get rid of the house. The house goes up to $515,000. You don't have to get rid of the house. That's how the covered call works. You have a house that's worth 500K. You say, hey, if it goes above to a certain level, I'm going to sell it. I'm going to have to sell it, right? That's how the covered call works. Someone thinks that the stock or the house or that asset will go up. And you're saying, hey, maybe it will go up. I will enjoy the appreciation as it goes up. And then, yes, I'll give it to you. But you owe me some money right now, this very moment, for that potential risk that I am taking. So again, the risk that you are taking is that you will have to sell your stock for more than the current price, right? If it's out of the money, if you sell a covered call that's out of the money, it's higher, then you have to sell at that price. So you will be forced at expiration of that option to sell your stock for more money, for higher than its current price. So if you have a stock, for example, on the screen, you'll see you have a stock at $100, you sell a 110 call option, you must sell at 110 if the stock goes above 110 at expiration. So a stock that you buy for 100, you must sell for 110. So I said that a few times on purpose because I wanted you to be like, that is amazing. I have to sell a stock for higher. Yes, exactly. That's exactly how the covered call works. It's almost like too good to be true. It is such an easy strategy that you get paid for to sell something for a more expensive price. So why is it called covered? Well, it's called covered because you own the shares. You already have the shares. And if exercised, you will be delivering your shares or losing your shares to someone else, right? So this is a safe strategy because you are covered. You have the stock and you are covered in case you lose the shares. And the income mechanism here is the premium that you get paid immediately when you sell a call option. So the cash hits your account immediately right away. You can withdraw that cash and use it for whatever. And that's what I've been doing in my own portfolio is you can see here, I have a lot of different positions which I have sold covered calls. And we'll talk about some of the returns here, which for the most part is very, very consistent. I have a very big position on XLC. I think it's a $1 million position just because I parked my money there. And it's showing a $74,000 loss. But let me show you the risk. Okay, so I'm going to go to XLC because even like the biggest, hugest loss that looks like a really huge loss, yeah, it's 1.16 million. You can see here how I'm up $216,000, but I'm down $74,000 on the option. So even like the biggest issue that's like, wow, there's a huge loss on the covered call, you're never going to lose more on the covered call than you would on the stock itself or the ETF because the ETF is going to make a lot more money. It's shares. So those shares move one for one. If it's $1 move, then it goes up by $1. But an option does not go one for one at all, especially if it's an out of the money low delta option, right? So if it's low delta, I usually trade deltas around 30. So if you're selling covered calls, go for around 30 delta. Take note on that. That's kind of like the sweet spot delta. Yeah, that means when the stock goes up $1, the option goes up 30 cents. So yes, the covered call will move against you if a stock ends up rising a lot, but that's not really an issue at all because you are essentially making so much money on the stock itself. As you see, I'm up over $200,000 where I'm down $70,000. So my net benefit is $130,000 and I use the very safe ETF, which is XLC. I like this ETF right now and I trade it in my Discord community because essentially, it has Meta, Google, and I've been very bullish on Google. And for good reason, Google has recently gone up a lot and I've recently made a video on Google. So you can always check out my channel and be subscribed for more of my video analysis on good stocks to buy and option strategies. Now, I want to go into a scenario analysis a little bit here on Microsoft stock and show you using a graph and things on the screen so you can really master this visually. We humans, a lot of us learn visually. I myself, I'm visual, so I like to see something to really understand it. So once you go through this example, I promise you, you're going to be at the next level for covered calls. All right, so let's talk about Microsoft. Let's say that you own 100 shares at $420 and you sell a $430 call option 30 days out. You collect $5 in premium. So you collect $500. Each option is worth 100 shares. So to do the covered call strategy, you must own 100 shares of the stock. So in scenario one, let's say that the stock stays below your strike price. So Microsoft goes to $425 at expiration. The stock actually goes up by $5, but the call will still expire worthless. You will keep all your shares and you will keep the premium, and the stock went up by $5. So you made money on the stock and you made money on the premium. And at expiration, since it's below the strike price, you don't have any obligations. You just simply do nothing and the option is out of your account. And then you just have your shares and the option expires. It's worthless. It's not worth anything. It's out of the money because it didn't go above the strike price that you sold. It did not go above 430. So as long as it stays below 430, then you are good and it essentially expires worthless and you can sell another call option next month. This is exactly how you create monthly income is when the stock stays below the strike price, that option expires and you can do it all over again. Now that's scenario one. It's usually the case is scenario one, but in bull markets and in good markets, if you go not too far out of the money and you sell a covered call option that's very close, then yes, you can get into scenario two where your stock goes above the strike price of the covered call option that you sold. So in this case, let's say that Microsoft goes to $440 per share at expiration. Now the shares get called away at $430 because that's your strike price. So you sold the strike price at $430 and Microsoft goes to $440. So now in this case, you still make money, you still participate in the gains because you bought Microsoft for $420 and your covered call was $430. So you made $10 per share in gains. And still, just because the option is in the money and it goes above your strike price doesn't mean the premium is not yours. The premium is still yours. So the premium that you've collected of $500 is absolutely still yours, and you've collected that the moment that you sold the option. So now your total profit is $10 that you made, or that's $1,000 for 100 shares, and you still get the premium of 500. So your total profit is 1,500. So even if the stock goes above your strike price, you've made $1,500. Amazing. If the stock is below, you've made $500 just on the premium itself, and whatever the stock went up, right? In our first scenario, if Microsoft went up $5, then you would make $5, and then you collected premium, so you made another $5. That's $10 or $1,000 in total. Here, if Microsoft goes up to $440, you have made $1,500 because you have made $10 in gains plus 500. Now, if Microsoft went up to any price, your maximum profit can still only be the 1,500. So this is like the issue that you are capped. You can't make more money than the $1,500, which is fine because let's say in 30 days, $1,500 is good money for you, right? So that is a good thing, right? Now, scenario number 3, the stock drops. Microsoft ends up going down to $410 per share. So Microsoft was at $420, now it's at $410. And you got to ask yourself, well, what happens here? Well, let's take a look at it. You still get the premium of $500, right? That's what you sold the option for. And that's, the money that you've collected. But now Microsoft is down $10. So you're down $1,000, but you collected $500. So you're only down $500. So if you actually think about it, anyone that has a stock would be down $1,000 where you're only down $500, and that's because of the money that you've collected in premiums. So you have actually saved yourself $500 because of the premium that you collected, and the stock ended up going down. So you ended up doing something called a hedge. You've hedged yourself, you've protected yourself against some of the losses. The visual breakdown here is actually amazing, even on the downside, because as investors, the stock market is random in the short term. In the long term, it's predictable if you understand fundamentals and valuations of businesses. And in the short term, you can't predict it. So if you're doing options that are 1 month, then you can actually end up saving a lot of money in protecting yourself and being way better off than just stock investors with the covered call strategy. Now let's talk about choosing strikes, because many of you will think right now, well, what strike price should I choose? How do I choose a strike price? So we can use Palantir right now as an example. I'm going to open up Palantir on the screen, and we can talk about a covered call position on Palantir. So you have to first of all have an outlook, okay? To know what covered call to trade, you must have an outlook. And an outlook is simply, are you very bullish? Are you neutral? Are you slightly bearish? Or do you want to get out of the stock and you want to exit, right? I've talked about in the money covered calls, which would be an exit strategy. But let's keep it simple right now and talk about just being very bullish, okay? So here's Palantir. I have $428,000 on Palantir. I'm up a lot of money and it makes up 10% of my portfolio, right? So let's talk about a covered call position on Palantir. Palantir is at about $165 per share. And if you were very bullish, right, I'm going to go for an option right now, and I'm going to sell an option that's, let's say 70 days out, 2 months away, right? And I'm going to go for an option that will be, let's say it's going to be 170. So Palantir 170, that would be very close, and the delta here is incredibly, incredibly high. If I go for the 180, the delta is going to be lower, but still pretty high, right? If I go for 190, this is going to be around the sweet spot delta of 33, which I recommend. This is the delta that I personally like. So if I sell this option right here at the 190, you will see that essentially here I can collect $800. I will collect $800 in premium, and if Palantir goes up any amount up to 190, I get all of that. That's all gravy. That's all coming into the pocket that you will make money. Your pocket will grow up until 190, and at 190, you will not be able to make any more money because the covered call will now be, someone else's essentially. Someone else will be able to exercise early, which rarely ever happens. By the way, if you want to see, just watch this 1 minute real quick clip that I made about assignment risk. Assignment risk is incredibly low. I just want to get this out of the way before we continue. So here's a 1 minute clip, and then let's continue. Here's exactly how to tell if you're at risk of being assigned when selling a put option. So let me illustrate how this works with the chart. Let's say that you're selling a put option 100 days until expiration. The bottom of the chart will represent days, and the left-hand side of the chart will represent delta, which is essentially a scale of how likely you are to get assigned on a scale of 0 to 100. And we're showing right now a line of assignment risk. You see how the assignment risk goes way up as the days are approaching 0. Your safe zone is right here. This green area is from 100 days and beyond. You're very, very safe. Now you see here is your moderate zone. The moderate zone really starts to happen in the final month, especially in the final 2 weeks. See, if delta is high, there's still a lot of time left. It doesn't really matter. Your assignment risk is still very low. However, if delta is 50 or higher, in that range, it starts to become moderate, especially in the last 2 weeks. Now you see here the risk zone. The risk zone where delta is say 60 to 100, that's where your risk starts to really go up. So for example, if you have an 80 delta option and you have sold a put and it's 80 delta and there's only 3 days left, you are definitely in the risk zone and your chances of getting assigned might be 50% or more. Now, as you've seen, the assignment risk is very, very low. It only gets into the territory of the last kind of final days, especially when the delta is very high. So if Palantir even goes up to 2, you're still not going to get exercised early, okay? So you don't really have to worry about early exercising for the most part, right? Now, Palantir, if it goes to 188, no worries. The $8 in premium that you collect is still yours, and you have a huge benefit from 165 to 188. So you would make $23 in upside and $8 that you've collected in premium here. So yeah, it's amazing. And your break even is going to be 198. And what I mean by break even in the chart here showing a negative, it's only showing a negative here. It's because Robinhood is not taking into account, well, it's because I don't have more shares actually as well, that this short call option doesn't have stock behind it. So like I said, we're doing covered calls, meaning that we have stock, 100 shares of stock, and we're selling a covered call for each 100 shares. Because I don't have a free 100 shares, it's showing me that there is going to be a loss, which is not the case if you do have the shares. You do not experience a loss. If Palantir goes up, you experience a very nice gain. So in terms of your outlook, in terms of strike prices to pick, this is an example of a very bullish outlook. If you are more of a neutral outlook, you would not go so high. You would not go for 190. You can go for something like 175. And in fact, the 175 would be even better in terms of premium collection because the premium that you collect is more. You can see here it's $1,260. Now you don't have as much upside benefit. Your benefits would stop at 175 of Palantir shares rising, but hey, $10 going up plus you get $12.60. That's a really amazing return. Now, in terms of exiting the covered call strategy, you should watch more of my videos on in the money covered calls. I made a couple of videos on that, and we will skip the portion of that so this video does not get too long. That's a little bit more of an advanced strategy, and we're just talking about simply doing covered calls, which almost all the time is going to be at a delta of around 30. Sometimes you can do a more closer to the money option, and that could be a higher delta. And that's basically going to give you less upside, but more premium. And more premium is nice because we're generating income. That's our whole goal, right? Now, I didn't really talk about expiration date so much. Let's talk about time frame intervals real quick, okay? There's multiple different time frames that you can use. One of them is weekly. You can use weekly options, especially if you're a new trader or more of like a beginner. Oftentimes in my Discord community, I will educate my investors and say, hey, weekly options are completely okay. They are okay, especially if you're a beginner. It gets you more reps under your belt. So every single week you're making money. However, the truth is weekly options are a little bit more work. They're more management, and they're not necessarily better than monthly options or even 2-week options. So you can use 2-week options that expire in 2 weeks. Double the amount of money for 2 weeks pretty much upfront. It'll vary a little bit. It's not going to be exactly double because there is other factors and options. These are called the Greeks, and we won't talk about the Greeks too deeply in this video, but simply said, delta, theta, gamma, rho, vega. There's some other deltas that you don't have to be like an expert on to make money with, but they do affect option pricing. So when you look at weekly, monthly timeframes, they're going to be a little bit of a discrepancy, but I promise you on the long-term basis, there's not that much of a difference. So just don't worry about it. If you're busy, if you're a professional, especially if you're watching my videos and you're one of the similar students that I have, some of the clients that I work with, doctors, lawyers, dentists, healthcare professionals, engineers, software, right? All that type of professions, very busy. So monthly options are going to be way more beneficial since you don't have to do as much work. You don't have to check your portfolio all the time. If you're busy at work, good. Focus on income and generating money in your salary, and then your investments and covered calls should be producing income. They should be producing income on stocks, which is really more of a passive income source, right? You should be using covered calls to produce income on your stocks. Make your stocks work for you, not you working for your stocks. Make your stocks work for you, and then just take that passive backseat approach where your stocks are appreciating and they're producing income via the covered call strategy. So that's what I would do. Weekly options for me is kind of a no-go, especially as you get more advanced, because it's more active management. It's smaller upfront premium, so there's a little bit more risk to if the stock goes down, then you're not going to really be able to do covered calls as easily or make as much money compared to your average cost. Okay, so the sweet spot for me is really that monthly amount, and I really like it because monthly options still have high theta, and theta is time decay. So time decay means that your options are getting cheaper and cheaper. So let's go over like a quick example again. Essentially, you would just buy 100 shares of Palantir. You would go to an expiration date. You would go to sell call, whatever brokerage you're using doesn't matter, and then you would pick a strike price that's appropriate for you. Again, if you're not that bullish, but you like the stock, you want to just produce income, you would go for something really close to the money, like 170. And if the more you like it, the higher that you should go here, right? You should go higher and higher. The premium that you collect will go down, especially the higher that you go, because there's less of a chance that will happen. And because there's less of a chance, there's, the other traders that are smart are less willing to pay you as much money because the chances of this happening continue to reduce the higher that the stock goes. If you want a free course on covered calls, well, I have that for you on YouTube. I put in a lot of work to make free content that's better than everyone else's paid content. So make sure to watch this video on covered calls. It's a full breakdown and full guide, a master course, you can say, on covered calls. So I'll see you there.